All right, welcome back to The Explainer. Today, we're literally putting on our financial detective hats. When you're looking at raw market data, it can honestly feel like staring at this dense, impenetrable wall of numbers. But here's the thing. Every single number tells a story. You just have to know how to read it. So today, we are turning our magnifying glass squarely onto International Seaways. That's ticker symbol INSW. We're going to sift through their latest financial and valuation metrics leading up to 2026 just to figure out exactly what is happening beneath the surface of this company.
To keep us from getting totally overwhelmed, we're going to break this investigation down into four logical pillars. First, the INSW snapshot. Then we'll ask, is INSW undervalued? Third, we'll look at financial health and profitability. Fourth, growth, returns, and dividends. And finally, we'll wrap it all up with the final verdict.
Okay, let's jump right into Section 1, the INSW snapshot.
Right off the bat, we have to talk about the recent price action, because wow, just look at that number, 79.61%. That is INSW's phenomenal year-to-date return in 2026, putting their last closing price at $84.58. I mean, think about that for a second. For a stock to rally almost 80% in a single year, that requires some absolutely serious underlying catalysts, or, at least some tremendous market enthusiasm. But hey, as financial detectives, we know that looking at just 1 year in a total vacuum is a total rookie mistake.
And this right here brilliantly illustrates exactly why context matters. If we look at the yearly returns over the last few years, we see some extreme boom and bust volatility. I mean, it's wild. In 2020, shareholders suffered this brutal 44% drop. But then, fast forward to 2022, and boom, a massive 162% explosion upwards. And now, in 2026, we're riding another huge 79% spike. So this tells us right away that we are dealing with a highly cyclical, super volatile asset. The shareholders who actually held on through all those wild swings, yeah, they've been handsomely rewarded. But man, it has definitely not been a smooth ride.
All right, moving on to Section 2, is INSW undervalued? So now that we've seen that explosive growth and all that historical volatility, let's transition to the big question that is literally on every investor's mind right now. Is this stock just way too expensive after this massive 2026 run, or is there still some hidden value to be found? Before we dive into the hard data, let's do a super quick refresher. The price to earnings, or PE ratio, is your classic valuation metric. It simply measures what the market is willing to pay today for exactly $1 of the company's annual earnings. Usually, a lower number implies the stock is cheaper relative to the profits it's generating. So keep that baseline in mind as we analyze INSW's specific numbers.
Now, if we just look at it in a total vacuum, a current PE ratio of 7.70 sounds incredibly cheap, especially compared to the broader market. But again, context changes everything. That 7.70 is actually 10% higher than its own 3-year average. And get this, a whopping 53% higher than its 5-year average. So the absolutely crucial takeaway here is that while the stock might look like a total bargain to an outsider, historically speaking for this specific company, the market is currently charging a pretty steep premium compared to what it used to.
So if the historical PE says it's getting kind of expensive, but the absolute PE says it's cheap, what is the true fair value price of INSW? Well, this leads us to one of the most fascinating contradictions hidden deep inside our source data.
Check out this crazy divergence. When we calculate fair value based on free cash flow, the data shows a margin of safety of negative 16.36%. That gives it a fair value price of just $72.69. So by that metric, at its current $84 price tag, it is clearly overvalued. But, and here's the kicker, if you look at the margin of safety based on accounting earnings per share, it sits at this incredible positive 62.39%, suggesting a fair value of almost $225. It is exceedingly rare to see a split this massive. What it tells our inner detective is that the actual cash the business is freely generating right now is lagging way behind the earnings they're reporting on the accounting ledger.
Let's pivot to Section 3, financial health and profitability.
To really understand why the market might be willing to pay this premium, and honestly to help settle this whole valuation debate, we need to lift the hood. Let's see how this valuation builds on the actual underlying health of the business. Remember that extreme boom and bust cycle we talked about earlier? Well, in highly cyclical industries, survival during those ugly bust years literally all comes down to leverage. So as detectives, we've got to ask, is INSW carrying too much debt to survive a sudden market downturn? The answer here is going to surprise you.
0.27, that is their debt-to-equity ratio. In a capital-intensive industry like this one, seeing a number this low is just staggering. It means they have an exceptionally rock-solid, incredibly low-debt balance sheet. For every single dollar of equity, they only have 27 cents of debt. And remarkably, this is roughly 50% lower than their 5-year average. So they haven't just been sitting around, they've been actively, aggressively de-risking their balance sheet.
And honestly, it gets even better when we look at their short-term survival capabilities. To do that, we use something called the quick ratio. Simply put, this metric measures a company's ability to meet its immediate, short-term obligations using only its most liquid assets. Things like cash. Generally speaking, you want to see a ratio of at least 1.0 to feel pretty safe.
Well, INCO's quick ratio isn't just 1.0, it's 7.28. No way, right? This brilliantly illustrates that the business has immense, almost unprecedented liquid resources on hand right now. In fact, that number is up 121% from its own trailing 12-month average. To put that into perspective, if the entire market were to crash tomorrow, INSW has an absolute fortress of short-term liquidity to weather the storm without even breaking a sweat.
And here's the thing, they aren't just hoarding all this cash, they are highly efficient at generating it. They're boasting a return on equity of nearly 25% and a return on invested capital of 18.67%. But for me, the absolute star of the show is that bottom number right there, a net profit margin of 37.51%. That literally means for every $100 of revenue they bring in the door, they are keeping roughly $37.50 as pure net profit. That is the definition of a highly efficient operation.
All right, on to Section 4, growth, returns, and dividends. So we've seen the crazy price action, we've debated the valuation, and we've verified that the health of the company is pretty much bulletproof. But ultimately, what is the actual payoff for the shareholders who are holding this stock? Well, over the last 5 years, revenue has grown at a really solid 23.48% annually. But look closely at that net income. It is compounded at an astonishing 65.72% per year. Because they've managed to expand those fat profit margins we just talked about, their net income growth has heavily outpaced top-line revenue growth. And that incredible efficiency, that's what drove a massive 46.50% annualized total return for shareholders over the last half-decade. And if you zoom out even further, you get this absolutely jaw-dropping figure, 1,312.49%. That right there is the 10-year return for INSW. For the ultra-patient investor, the one who gritted their teeth and rode out those negative 44% drops and wild cyclical swings, this is the ultimate long-term shareholder reward. It's just a fantastic, clear reminder of how powerful compounding can be when a company properly manages its debt and absolutely maximizes its margins. Now, what about the income investors out there looking for dividends? On the surface, I know the current dividend yield of 0.57% looks tiny, kind of negligible, right? But as detectives, we always peel back a layer. Look at that payout ratio. It is exceptionally low at just 4.35%. That means they're only paying out a tiny fraction of their overall profits as dividends. When you combine that with a 5-year dividend growth rate of nearly 15%, this tells us the dividend is not only incredibly safe, but management has plenty of room to drastically expand it in the future if they ever choose to do so. Finally, Section 5, the final verdict. All right, we've poured over the valuation multiples, the liquidity ratios, the margins, and the historical returns. Let's wrap up this financial investigation by putting all these puzzle pieces together to form our final picture. What our explainer reveals today is a company of total extremes. Step 1, we've got this undeniable, explosive recent price action with a nearly 80% run this year alone. Step 2, because of that massive run, we are getting incredibly mixed valuation signals. The PE is trending higher than its historical average, and there's a huge, literal tug-of-war happening between its free cash flow fair value and its earnings per share fair value. But step 3 is the real anchor here. The fundamental business is currently a total fortress. We're talking a remarkably low debt load, an off-the-charts quick ratio, and near 38% net profit margins. Which brings us to our final question for you to ponder today. With the stock commanding a 53% premium to its historical earnings multiple, has the ship already sailed on INSLW's fair valuation? Or does a business with a completely bulletproof balance sheet, massive short-term liquidity, and 37% net margins fully justify paying that premium today? Well, the numbers are on the table, detective. It's ultimately up to you to decide how to weigh them. Thanks so much for joining us on this explainer, and as always, keep questioning the data.